The trust wants to make sure it can service paying you what it owes you.
What are the restrictions? And it sounds like it's at 20% holdback, I guess I'd call it, or deferral. Is that stuck in that reserve account in perpetuity, or what happens to it? How can you pull it out and get it out of there?
Great question. So it depends on the liquidity of the trust. And so let's back to your example. Now your $2 million is sitting in your trust and you find another apartment complex you want to invest in. So let's just say it's 1.6%. 1.6 million is 80%. So 1.6 million goes into this next deal. So now you're in a situation where you only have 20% liquidity, right? And 80% illiquidity because you're back into this real estate deal. So in order to take any of this cash out, you need to sell this investment here, move it back into this. Now you can cash out of everything and pay the tax. So that's the only time we're restricted from really accessing all of the capital is when we want to make sure there's liquidity for the trust. And why is that? Well, because the trust needs to pay you back, right? So it's the same reason a bank might say to you, hey, Kyle, I'll give you a loan on this new multifamily property, but we're going to need, a couple $1 million or $1 million or a couple $100,000 as a reserve account. It's still your money. It's still earning interest. But we want to make sure you can service the note. It's the same concept here. The trust wants to make sure it can service paying you what it owes you, also paying the tax return, paying the trustee fee, paying the financial advising fee along the way. So that's why we cap it at the 80% LTV. But as soon as you sell it, you can cash out of everything. But most of our notes go for 10 years. Most of our clients like to pay the tax the second day to never. So they're going to keep renewing every 10 years for 10 years. The typically its target rate is 8%. But when you go off into your other deal, you can make as much as you want. And we can carve out a lot of that upside just for you. And you're just going to keep rolling it back in every single time and getting a brand new depreciation schedule along the way. So hopefully that answers your question. But any thoughts on that?